Will your Social Security benefits become tax-free in the near future? We've been receiving numerous questions on this topic as it has some massive implications for retirees. In this video, I want to break down the possibility and also repercussions of this proposal. The concept of tax-free Social Security is not a new one. It's been previously proposed by congressmen and women before. However, the seriousness that one would take these proposals has gone up as the Trump administration not only campaigned on this proposal, but also reaffirmed their goal of making Social Security tax-free in recent meetings with Congress. Part of this is driven by the trend that more and more retirees are really feeling the effects of taxation. Social Security was first made taxable in 1983, and only about 10% of recipients saw taxable benefits. The problem is the formula used to determine Social Security taxation was never adjusted to inflation. So as inflation not only increased benefits, but also increased the amount that you need to take from your other assets, more and more retirees have seen their benefits now become taxed. Today, approximately 50% of retirees now pay taxes on Social Security. From the polling that I've seen from really both parties, eliminating Social Security tax seems to be a bipartisan issue. After all, many individuals find issue with the idea of paying into Social Security for years through a means of taxation, only to find that their benefit that they've worked so hard to accumulate will now also be taxed in retirement. It doesn't seem fair, but there is more to the issue than what is fair or unfair. Social Security is currently structured in a way where it is somewhat dependent on those Social Security taxes. Let's go through the structure fairly high level. Many Americans don't realize that Social Security is set up in a way where current payroll taxes collected from workers immediately goes to retirees relying on Social Security. It's not as if there's some bank account or investment account set up for you personally that your tax dollars go into that you then draw down from in retirement. Instead, dollars paid in, again, immediately go to those receiving Social Security benefits. Now, historically, this hasn't really been a problem. There used to be more dollars coming in from workers than needed to get paid out to retirees. Any excess dollars from workers would then go into something called a Social Security trust fund if there was ever to be a shortfall. Well, for the past few years, Social Security has been running a shortfall where worker taxes aren't enough to cover retiree benefits. So rather than adding to the trust fund, the Social Security Administration has been drawing down that trust fund. Now, when retirees see their Social Security benefit taxed, it's not as if those income taxes just go into the ether and get lost in all of the other spending the government is doing. Instead, those tax dollars actually feed right back into the system to strengthen the solvency of Social Security. Income taxes on the first 50% of your Social Security benefit go back into the trust fund, and any income tax on the next 35% of your benefit go into the Medicare Hospital Insurance Trust Fund. Hopefully you're starting to see the problem at play here. Every year, media outlets love to push on the fear around Social Security. You'll commonly see a headline saying Social Security is broke, or here's how to claim your benefit before Social Security is bankrupt. No doubt Social Security has its problems, and these problems need to be addressed by Congress at some point in the next decade. But it's certainly not bankrupt. If you look at the two most recent trustee reports, as it sits right now, the Social Security Trust Fund is set to run out in the 2034-2035 time range. At this point, if Congress has done nothing to remedy Social Security's financial problems, retirees will see a 21% cut in their benefits across the board. This is certainly not what any retiree wants, but is far away from complete bankruptcy of the system. The good news for retirees and the system as a whole is that there are a lot of simple ways to fix Social Security and extend solvency out into the distant future. The Committee for a Responsible Budget has a tool called the Reformer, which is a calculator that you can play around with a bunch of options that you can vary and see the effect it would have on Social Security solvency. For instance, here's an example solution with what I think are some relatively minor adjustments overall. With this, we see Social Security extended out to 2077, where retirees would only see about an 8% cut in benefits. Now, getting back to the Trump proposal to cut Social Security income tax, before getting into how likely it is, I first want to discuss the impact it would have on the system. If you're someone close to filing for Social Security or already are receiving your benefits, then a cut in income tax is no doubt a positive thing on a personal level. But the main issue is there's no offsetting mechanism on the other side of the equation. Remember that Social Security income tax feeds back into the system. What I mean by an offsetting mechanism is that if we look at really any proposed tax cut in the government, tax cuts are great. But if spending doesn't fall in proportion to that tax cut, we just poured gas on a problem that we now just kick down the road. At the very least, a tax cut in some area has to be offset by a tax raise in another area if no spending cuts happen. If you look at the effect of just simply cutting Social Security income tax without any offsetting mechanism, the solvency problems are just exacerbated. With just a tax cut, the date the trust fund is set to run out would move up to 2031. Now, a few year difference might not seem like much to some. After all, no income tax is a big benefit. But keep in mind, after this date, the cut to Social Security benefits would be much larger at an estimated 33% cut in benefits. Overall, a long-term retiree ends up much worse on a net benefit standpoint with a cut to income taxes. Now, to be fair to the current administration, this idea is much more in a talking points phase rather than there actually being a bill that Congress will vote on. I'd be quite surprised if an eventual bill was presented with only Social Security income tax being cut and there being no other offsetting mechanism. It's much more likely that if we see a bill presented, it includes cuts or taxes in other areas to make up for the deficit that cutting income tax creates. Now, when we talk about the probability of income tax actually being cut, the interesting thing is this is not really a one-party issue. Both Democrats and Republicans have proposed cuts to Social Security income tax before, fairly recently even. Given this, one might think that the probability of something like this going through is pretty high. Finally, there's something that both parties can come together and agree on. Well, not so fast. The problem with finding a middle ground will be in agreeing on that offsetting mechanism that I talked about earlier. If income tax is cut, how will the deficit be made up in some other area? Democrat proposals typically involve taxing high income earners more to make up for that deficit. For instance, right now, workers only pay payroll tax up to the first $176,000 that they make. Democrats have proposed lifting this limit and forcing payroll tax on all income regardless of the amount. The problem with that idea is that you only earn benefits based on the first $176,000 you make. So taxing workers above this amount without any corresponding benefit is on its surface inequitable. So let's talk about the likelihood of this being passed. The president cannot unilaterally change Social Security, including how it's funded, how much it pays beneficiaries, or how it's taxed. This is something that Congress needs to agree on. Social Security fits into a camp of what's called mandatory spending. If I'm not mistaken, I believe this falls into a similar camp as extending the Tax Cuts and Jobs Act permanently. When dealing with budget items, a 60% vote is needed in the Senate, where right now there are only 53 Republican senators. If a 60% vote is not achieved, there are some other measures where temporary changes could be made with only a majority, but again, those changes would be temporary in nature and would need to be deemed budget neutral. This would mean that a Social Security income tax cut cannot be made on its own. There would need to be some kind of offsetting mechanism to make it budget neutral. Given this, I think the main place this type of proposal will be solved is being able to agree on how to offset the deficit that eliminating income tax would create. But before discussing if you should be building this change inside of your retirement plan, let's talk about the individual impact of eliminating this Social Security income tax. Many of you watching this video have probably seen me walk through some tax problems that Social Security creates for retirees. Social Security is taxed on a sliding scale. What this means is that you will not owe any Social Security income tax just based on your benefit alone. It depends on the other income or withdrawals that you are taking. As you start taking withdrawals from your traditional IRA, for instance, you slide more of your Social Security benefit into becoming taxed. Here's a simple way to think about this. You might take $1 of income from a traditional IRA, but that dollar might actually force $1.50 or $1.85 of taxable income. So there is a double taxation of sorts happening here. Because of this, Social Security transforms your retirement tax brackets to something like what I have on the screen. Rather than being taxed at 10%, 12%, and 22%, you are being taxed at rates like 15%, 18.5%, 22.2%, and even 40.7%. This creates a big tax increase zone that many workers don't expect in retirement. When we talk about things like Roth conversions, many workers or early retirees will find benefit in Roth converting to avoid certain parts of the Social Security trap, what is often referred to as the Social Security tax torpedo. It's pretty obvious that you eliminate Social Security income tax and you eliminate this hurdle completely. This does two things. Number one, makes tax planning for retirees much simpler. Yes, there are still complex tax hurdles retirees need to consider, but far fewer retirees are affected by those tax hurdles, whereas nearly every retiree needs to think about the Social Security tax torpedo. Number two, no doubt retirement plans become stronger when we just look at Social Security income tax being eliminated. Right now, a married couple with strong benefits might see $5,000 plus of their benefit going to taxes. Eliminating that and adding this back into their plan on an annual basis can make meaningful differences long term. Now, no doubt, if Social Security income tax is actually cut, every retirement tax plan would need to be reworked. However, this is not something I would start planning around just yet. Making predictions about what Congress and the government might do is incredibly difficult, but I think it's much safer to bet on inaction rather than betting on a certain direction. Plan based on the rules that we know today and adjust as they change. The key here is to be dynamic in your planning and be swift in making changes once rules actually change. Hopefully this video will help provide some clarity around some big Social Security questions. If you're worried about the overall solvency of Social Security and if it will even be around for your retirement, click on this video right here where I talk about 5 reasons Social Security is in much better shape than you might think. Click here to learn more, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.